On April 13th, 2025, something unbelievable happened. In just 65 minutes, over $6 billion vanished from the crypto markets. One token OM, the native asset of the Mantra network, collapsed more than 90% in value. It wasn't a slow bleed, it was a cliff dive. And for many investors, it came out of nowhere. This was not a meme coin. This was a project that had just launched a multi-million-dollar real-world asset tokenization fund. It had deep ties to institutional investors. It was regulated in Dubai. It was featured in analyst reports as a pioneer. And yet it crumbled in under an hour. So what really happened to OM? And more importantly, what lessons should every serious crypto investor learn from this? Let's break it down. First, let's zoom out. The year is 2025. Crypto is no longer a fringe experiment. It's financial infrastructure. BlackRock and Fidelity now operate Bitcoin ETFs. Ethereum is widely adopted in enterprise settlements. Solana handles millions of daily retail transactions, and real-world asset tokenization, or RWA, is the hot narrative. From US Treasury bonds to luxury real estate and even carbon credits, blockchains are now being used to tokenize assets that were once trapped in traditional finance. Everyone is chasing three things: yield, compliance, and real-world utility. And Mantra was positioned right at the center of this movement. Mantra is a blockchain ecosystem focused on tokenizing real-world assets. This includes real estate, debt instruments, environmental credits, and more. Their pitch was clear: take regulated real-world assets and bring them on-chain through a compliant, modular framework. It wasn't just talk. In February 2025, Mantra received a full operational license from Dubai's Virtual Asset Regulatory Authority, or VARA, a major stamp of credibility in the MENA region. They also announced the launch of a $108 million ecosystem fund. The goal? To invest in DeFi protocols, real-world asset startups, and tokenization infrastructure across the region. The backers of that fund weren't small players. Laser Digital, the crypto arm of Nomura. Sharuk Partners, a leading venture fund in the Gulf. Amber Group. And even Brevin Howard Digital, a name with deep roots in hedge fund circles. Everything was lining up. OM, the native token, had utility. It powered staking, governance, and fees across the Mantra chain and its side applications. Its market cap surged into the billions. It was one of the top-performing RWA tokens of the year. But behind the headlines, something was brewing, not visible on charts, but visible on-chain. It started with whispers movement of large OM wallets to exchanges. No press release, no warning, and then came the moment that would be replayed in trading rooms and Discord channels for weeks. On April 13th, a large market sell order hit the books. Immediately, OM's price dropped. Then came the cascade. OM had been used as collateral in multiple DeFi protocols. It was staked across liquidity pools. It was heavily integrated in yield strategies that relied on leverage. As the price fell, collateral ratios failed. Liquidations triggered, bots started selling. Within minutes, it was like the floor disappeared. Imagine standing on solid ground and suddenly, it's quicksand. OM dropped 40% in under 20 minutes. At 40 minutes, 70% gone. By the 65th minute, the token had disintegrated, more than 90% vanished. Liquidity evaporated. Slippage spiked. Investors couldn't sell. Some orders were filled at pennies. $6 billion gone. Retail investors flooded Telegram, Twitter, and Discord. But from the Mantra team, silence. No tweet. No update. No explanation. Crypto YouTube channels went live. Reddit threads exploded. Some traders posted screenshots of their portfolios down 95% in less than an hour. One user wrote, "This is worse than FTX." At least they pretended to respond. The silence wasn't just painful, it was damning. Influencers accused the team of insider trading. Blockchain analysts posted wallet addresses that matched known early investors dumping millions of dollars worth of OM. By the time the Mantra Foundation finally posted a response, The damage was irreversible. So what went wrong? Let's look at 5 key breakdowns. Number 1, over-leveraged tokenomics. OM had aggressive emissions, high staking yields, and rewards designed to grow its ecosystem rapidly. But these same incentives created sell pressure the moment sentiment flipped. Rewards became liabilities, and the market could no longer absorb the supply. Number 2, liquidity fragmentation. OM was heavily concentrated on a handful of exchanges. On-chain liquidity was shallow, OTC desks weren't active, and there were no market makers defending a price floor. The sell cascade hit empty order books, which accelerated the plunge. Number 3, infrastructure stress. Because OM was used across multiple DeFi protocols as collateral, the crash didn't just affect spot holders. It liquidated users in lending protocols, vaults, and staking platforms, even those that had never sold a token. This created a domino effect. A single sell turned into a full system unwinding. Number 4, team communication. Mantra's silence during the most critical hours signaled disarray. Crisis communications are essential in crypto, especially in a crash. Without leadership, panic fills the void. And number 5, perception of betrayal. When it was revealed that internal wallets had moved OM to exchanges days before the crash, the story shifted. It wasn't a bad token anymore, it was an insider event. The community felt betrayed. And in crypto, trust is everything. To their credit, the Mantra Foundation did act quickly once the extent of the damage was visible. They announced a 300 million OM token burn. 150 million of those tokens came directly from the founder's personal allocation, an attempt to show accountability and commitment. Token burns reduce circulating supply and are often used to signal alignment between the team and the community. But burns don't restore trust. The community wanted answers. Why were insiders moving tokens before the crash? Why weren't alarms raised earlier? Even crypto media picked it up. The headlines were brutal. Mantra or Mirage, the tokenized future that collapsed in 65 minutes. The burn was confirmed on-chain, and OM's price rebounded slightly, from 5 cents to 12 cents. But the reputation damage remained. So where does this leave OM? Let's divide it into 3 lenses: technical recovery, reputational recovery, and investor strategy. First, technical recovery. The Mantra team has proposed updated tokenomics. They plan to reduce emissions, add lockups for ecosystem rewards, and build a circuit breaker to prevent rapid price crashes in the future. They've also pledged full transparency on token allocations going forward, with third-party auditing of team wallets. Some developers have returned to the community. Daily active addresses have stabilized. Transaction volumes are modest, but not dead. Technically, the chain is alive. Second, reputational recovery. This will take longer. Institutional partners have not issued public statements, but several have gone quiet. Twitter engagement has dropped, and many influencers have removed OM from their watch lists. Trust has a long half-life, especially after a scandal. Third, investor strategy. Is OM still worth watching? It depends. At a 90% drawdown, the upside is tempting. If Mantra stabilizes and repositions itself, OM could increase by 5 times or even by 10 times in a bull market reversal. But that's a big if. The safer play is to wait for proof of new partnerships, proof of developer activity, proof of stabilized tokenomics, proof that the team learned from its mistakes. If you're not seeing clear signals, wait. And remember, there are dozens of RWA projects competing right now. Projects like Centrifuge and Ondo Finance are building similar infrastructure with strong compliance frameworks, and Maple is doing the same with even less volatility. The RWA space is real, but competition is fierce. If Mantra wants a second chance, it will need to earn it. So what can we learn from this collapse? First, fundamentals still matter. Hype can only carry a token so far. If tokenomics are flawed, liquidity is thin, or leadership is unprepared, a collapse is only a matter of time. Second, regulation is not a shield. Being licensed does not protect you from volatility or internal mismanagement. It only adds a layer of oversight, not immunity. Third, wallets do not lie. On-chain transparency is one of crypto's greatest strengths. Watch wallet movements, use tools like Arkham or Nansen, and if insiders are sending to exchanges, it's a warning. Fourth, the crypto market is still unforgiving. It rewards innovation, but it punishes arrogance, silence, and opacity. The difference between a thriving token and a dead one? Often just 1 hour of panic or 1 day of silence. And finally, have an exit plan. Whether you are a trader, a long-term holder, or just experimenting, always know your thresholds. Set alerts, use stop losses, track token unlock schedules. Know where the exits are before you need them. The OM story is not just a tragedy, it's a blueprint of what can go wrong and how fast it can go wrong when fundamentals are ignored and transparency breaks down. $6 billion evaporated in 65 minutes. That number should haunt every serious investor, because next time it might not be OM. It might be the token you're holding right now. Stay sharp, stay informed, and never forget in crypto, speed is everything. The speed of growth, the speed of collapse, and the speed of your reaction when it all begins to unravel. If this video helped you understand the deeper risks in the crypto space, take a second to like the video and subscribe to Crypto Wayfarer. We break down the stories behind the charts, the fundamentals, the macro shifts, and the signals smart money is watching. And if you've got thoughts on OM or real-world asset tokens, drop them in the comments. I read everyone. More hard truths, more strategic plays, coming soon. Until then, stay focused and stay wayfaring.